You are studying ICT concepts all wrong. If you've been in the space for a while, you've likely seen this, the ICT PD array matrix. And if you're anything like me, you would have tried to learn all these things all at once. But I'm here to tell you that you're taking the wrong approach. You need to look at these PD arrays like building blocks, where one has an impact on your understanding of another. So in this video, I'm going to simplify the PD array matrix so you know exactly what to focus on to improve your trading. Also, if you're new to the channel, make sure you download my full free strategy. I'll leave a link in the description. So without further ado, grab your notebooks and let's get started. All right, so let's talk about the PD array matrix. Now, when you're first starting to get an ICT, the first thing, or one of the first things that you see is this table. And this is already where a lot of you guys are going wrong, as you see all these different things and you kind of assume that I need to implement all these all at once. And that's where, you know, you're gonna get confused as far as studying. You don't know what to focus on, and you really don't even have the right context. So let's talk about it a little bit, right? And there's a reason why it's drawn out like this, where, you know, this dealing range, right, between premium and discount is one of the most important things to understand before we even get into any of these, right? So this right here, premium versus discount, is way more important than understanding any of this stuff, because it's all about context and it's all about the right way to use these. And I guess what I've noticed from just teaching a couple students and just over the years, what I've noticed from people just reaching out to me and asking questions is they really don't have the right context for some of these to even be looking at the other ones. All right. And that's what we're going to go over today. And I'm going to try and simplify things for you so you can have a path forward and actually tackle these and understand that some of these are more advanced than others. All right. So, you know, without, wasting too much of your guys' time, this is going to be just a quick, straightforward video so you guys can understand where some of the pitfalls are so you guys can avoid them. All right. So first of all, we need to focus on liquidity and market structure. There's a reason why ICT developed his core content and back from 2018, why it was developed this way, because you have to have a basic understanding of liquidity before you even get into any of the other PD arrays. And that's something that I'm going to talk about as we go along here. And I look at them as being, basic skills to have, and then there's more advanced skills. So think of them as like prerequisites. You wouldn't want to, study business law if you haven't even taken business 101 yet, right? There's a sequence that we have to go about this if you want to become a better trader. And where I see a lot of people kind of get messed up is they see this and they think that they need to learn all these things first. So, they're looking at bullish breakers before they even understand premium or discount properly. And I'm not just talking about watching a 5-minute video on dealing ranges and then saying you understand it, because you don't. Understanding comes from practice, right? So there's theory and then there's practice. Your understanding of something doesn't translate into your actual execution of it, because it takes time for you to be able to see these things pan out and understand why they work. Right? Because you could literally only focus on dealing ranges for the next year, and I guarantee that you're still not going to be an expert in that. And that's where a lot of people are going to quit. That's where a lot of people are going to get extremely confused and not know where to continue their study path. So when I'm talking about a path, right, when we're moving along, there's different branches. Just assume that this is a video game, right? There's all these different skill sets, and let's talk about a skill tree. There's all these different skill sets that you have to branch out to. And then when you get to this specific node, right, it's going to branch out again. And then it's going to keep going on and on and on. So what you have to understand is, like, there is a specific path that you have to take for it to be efficient. You can't just go straight to the advanced concepts and just skip out on all the other stuff, because you're not going to have the right understanding when you're trying to apply it in the market. All right. We need to make sure that we're treating this professionally. And the professional standpoint when it comes to approaching markets is understanding that I might be a novice right now, but if I want to be an expert, I have to make sure I'm focused on the first parts first. Because if you have a terrible foundation, none of the rest matters. I don't care. It doesn't matter if you have the right, if you understand what bearish breakers are or bullish breakers. If you don't use them in the right context, they're going to fail on you. Okay. So let's talk about, old liquidity, old highs, and old lows. And I already see a lot of people, they message me and say, hey, is this a specific low or a high, or what do I do here? And a lot of the times they're not even marking out significant levels. Like they see a minor range like this, and they're saying that is their long-term high or low, right? When in reality, it's just like here, like the market structure has to be extremely, extremely obvious to you, because if it's not, then you're going to get a lot of context wrong. All right. So understanding our swing points comes first and foremost, right? That is part of market structure and is part of liquidity. What is an actual high and what is an actual low? Because there are intermediate or short-term highs or lows that I just don't even bother looking at. Those are not important to me. And if you've seen my last video on liquidity, you're going to understand that not every old high or old low is significant, right? Because in that order book, if there's just traders just going back and forth with each other, at what point does either side of that range is that significant? Maybe there's a higher high up here and then there's a lower low down here that is way more significant than anything that's happening in between. Okay, so this is like the first thing to study is our dealing range. And this is going to be subjective because you guys are going to, we're not going to have the same dealing ranges. If it was that easy, everybody would be looking at the same levels, but there are specific ways to go about it. It's just, what is the most obvious price swing? If it's not obvious, then I'm not even looking at it. Like, I'm not plotting any drawing tools on it. I'm not doing any analysis on it. It has to be blindingly obvious. Okay. So that's, once we understand our old highs and old lows, right? Our swing points, just understand what a swing point is, understand where they're going to occur, right? Maybe they're at previous weekly highs or lows, previous monthly highs or lows, and there's going to be price action in between, right? There's significant price swings inside of a month as well. So just studying market structure first and foremost is going to set the foundation for everything else that comes in line, okay? So once we understand our highs and lows, then we're going to get into dealing ranges. So dealing ranges, right? Basically, we're just trying to figure out what's premium, what's discount. And, this is where your market structure and liquidity is going to come into play as well, because not every... we're trying to split our dealing range in half and you're not plotting the high or the low where they should be, you're going to think some parts of discount are premium when they're really not, right? If you can kind of just visualize it, right? Like, let's say we had a swing point, right? Let me do a little bit better job of this. Let's just say we had a swing point from here down to here, and then we had here, right? And then we had here. Well, if you're measuring your swing point from here to here, what about this one, right? What about this high up here? Because down here, we are in a discount. So that is not a significant high to me. The significant high was back here, okay? So understanding, where am I going to plot that dealing range? Yes, there's a dealing range, but it's on a smaller time frame. And that has to come down to what time frame you want to operate in. If I want to find a high probability trade, I need to make sure that I'm picking and selecting the right swing points. That is like the building block to finding high probabilistic trades. And if you don't get this right, if you don't get these two right, everything else down here doesn't matter, because if you're picking out bearish order blocks that are in discount, you're already doing it wrong. All right, that is not a high probability trade and doesn't really make it a bearish order block. It has to occur in the premium of a dealing range. And finding that dealing range, right, is making sure that we're choosing the significant price runs. Significant. They cannot be just sideways price action and then you're just going off whim and saying, oh, this is a significant low. No, it should be visible to you. It should have moved away from that level with speed, right? And it should have taken out another previous high or low with it, right? So, it's easy to say in hindsight, but this is where practice comes into play, because being able to forecast it forward is a whole different skill set, right? Before we even get into order blocks, can I pick out an old high or an old low based on the dealing range? If you can't do that, then you might as well not even go towards the next pieces of the PD array matrix, because this all predicates on understanding, which direction are we at an extreme imbalance in the market? Are we at extreme lows or extreme highs? Okay. And where? Because if all of my bearish PD array matrices, PD arrays end up in the discount end of a range, what am I doing? Right? Like, I'm trying to sell when it's already sold off. That doesn't make any sense to me. All right. So the highest probability trades are when bearish PD arrays appear in premium. But there's a lot of traders out there that just don't understand where should the premium be. But that's because you're not understanding market structure properly, or old highs or lows, the significance of them. You can't just take this information, plot it on your charts and just assume that you're doing it correctly, because that's where the gap is between theory and execution. All right. So once we figure out the premium discount, right, then there's the order blocks. So order blocks obviously are opposing candles prior to price runs, you know, in a nutshell. So when the market is predisposed to go lower, prior to a bearish swing, we're going to have a couple up candles. So we're going to have a couple bullish candles, right, prior to the run lower, and that creates our bearish order block. And then running lower, right, you're going to have a couple bearish candles prior to a run higher, right? And then this is our order block here. So understanding where these order blocks should occur, because again, I see people marking out order blocks when they're not really order blocks, is so important. Like, not every candle is going to be an order block. That's where, you know, a lot of you guys are failing. The high probability order blocks need to create an impulse leg. And if you don't see expansion away from that level, it's not an order block, okay? It's just another candle in the range. So we have to understand that when we are looking at market structure and we're looking for order blocks, right, is that order block creating a significant price leg? If it's not creating a significant price leg, then I don't really have anything to work with. And these significant price legs, right, create new dealing ranges. So starting from the order block will create the new dealing range, all right? But understanding the dealing range first and foremost is going to be important, okay? Because when we get an expansion in a discount, right, now we're predisposed to go higher. And now it's a valid order block. But if you see an order block that's appearing in a major range of premium, a lot of times it's going to fail and turn into a breaker. And that's where your whole concept of, oh, this doesn't work, no, it's not that it doesn't work. It's just you don't have the right context around using the actual PD raise properly. Okay. Then once we have order blocks, then we're going to talk about fair value gaps, because why did I put it in this order? Because the high probability fair value gaps will have an order block below it. Okay, so we're going to have an order block, right? These prior candles running lower. Then you might have one big bullish candle, right? Which creates the fair value gap. So we really want to see order blocks being created, right? Bearish candles, and then one major bullish candle, and then this like this. Because then if we test the order block and fills in the fair value gap, then we have a possible setup. But we really want to see an order block below or above a fair value gap, because that's what's making it high probability. And especially when it's coming at the major premium or discount ends of the range. Then once we have a fair value gaps, then we finally get into breakers or mitigation blocks. And the way I figured out this order is because I see a lot of traders trying to trade breakers just because they see it here. They see it on the PD array matrix, but the context of it is totally off. Like, in order for it to be a breaker, it needs to create a swing point and then take out a previous high. But that becomes an order block. So you can't know what a breaker is if you don't know what the order block is. This is the order block here, right? It needs to create the order block and sweep liquidity. Both of those things appear up here on my list, right? So you can't understand a breaker if you don't understand the level of liquidity that's taking out. Because I see some people drawing breakers and it hasn't taken out a significant level of liquidity, or it's not in a premium or discount. Okay, so don't just skip ahead to these, because these are a little bit more advanced. I mean, fair value gaps, not so much advanced, but finding the high probability fair value gaps is more advanced, because you need all the other context before you get into these. And that's why I've kind of gone over this video in the context that don't just look at the PD array matrix and say, I'm going to try and learn all these things at once. Because you need to be able to sit down and just go through and really study these ones first, because these are providing the foundation for everything else. All right, you don't get breakers without understanding order blocks or liquidity, right? So this is like a level 3. If I was to put levels on some of these, right? This is like a level 3, and let's just say order blocks are level 2, and then liquidity is level 1. So in this context, right, we can't understand order blocks, mitigation blocks or breaker blocks, if we don't even know order blocks. And we can't understand either of them, or we can't understand breakers unless we have order blocks and liquidity, because That's what a breaker is. A breaker is a broken order block that raids liquidity. But if you don't have the right context and you're not looking at it properly, like, is it raiding the right level of liquidity? That breaker is not really going to work. Or maybe it's not even really an order block, right? You're just choosing a down candle, and you know, just assuming that the market structure is shifting. But what creates the breaker, right, is a market structure shift. So we have an old low, taking out an old high, taking out the old low again, and then reversing and then trading back into here. So this is an order block, right? But you need to understand that in order for it to be a breaker, it should take out a significant level of liquidity. Okay, so that's level 1. You know, so on our skill tree, we have to put points into liquidity, right? So once we understand liquidity, then we put points into order blocks, right? And after we get order blocks, then we put points into breakers. So don't try and jump here. You have to go through the path. The natural progression of a trader is understanding the PD array matrix takes time. And don't just look at this and say, all right, well, let me just go ahead and study mitigation blocks, when you don't even understand the other pieces of the puzzle. And that's why ICT laid it out in the way that he did, is that there is a natural progression for you understanding all of these concepts. You don't just get to break, and that's where I messed up as well. I tried to study breakers right away without realizing that my knowledge on liquidity was lacking, and that's why breakers were just failing on me. So what I did was I just stopped trading them. I stopped trading breakers entirely, and I just focused on order blocks, premium discount, and liquidity. These are the only things I focused on, because these are level 1 and level 2. At one point I wasn't trading fair value gaps, and then once I started to understand that fair value gaps create, you know, second stage distributions, that's when I'm entering in the market, and now I'm kind of operating in fair value gap area, but only after I have context on all these other 3. Like, I'm not just entering a fair value gap when I see it. I need to have context, and that context comes from liquidity, it comes from dealing ranges, it comes from order blocks, right? And you know, when I'm talking about all of this, right, don't just look at this and go straight to what sounds good. All right, even if you're watching videos on fair value gaps, if you don't have the rest of the context, like premium discount, dealing ranges, or market structure, more often than not your fair value gaps are going to fail. Okay, because what's a fair value gap? When you're trying to sell it, what's a fair value gap in discount? That's a low probability trade. Oftentimes you're going to have a fair value gap in discount. If you're trying to sell it, many times it's going to invert on you and go higher because you're lacking the narrative of the dealing range. All right, so don't say that these concepts fail. It's just you're using them improperly. So I know this was a little bit of a rant, but I hope you guys enjoyed the video and took something from it. I think the key is breaking down the PD array matrix. This way you can assess where you are in your trading journey and actually focus on improving. If you guys enjoy the content but want to work directly with me and trade live with me each week, make sure you check out the link in the description. Also, don't forget to like, comment, and subscribe, and I'll see you guys in the next video.